So what you're looking at is a 2-minute chart of Google. All right, now guys, there are two symbols for Google, two classes of stock. All right, so sometimes a company will issue a different class of stock and actually float both of them as separate trading items. All right, when you can do that, that's a special privilege to be able to do that, to be able to issue a different version of your stock and have them both trade. Google falls into that category. So you have GOOG, all right? That's the Class C shares. And then you have Google L, which are the Class A shares. Now, without going into any great detail, the different classes will have different rights for owners of the stock. All right. One might be no voting rights or fewer voting rights than another. That's not really important as far as our activity in the stock goes. What I am going to tell you is that Google L, the Class A shares, tends to have more liquidity. The spread tends to be tighter. The movements tend to be more fluid and true. So we lean toward trading the Google L versus just the Goog. Just wanted to let you know. All right, so you're looking at a 2-minute chart of Google L. Obviously, you know the two main moving averages are staples on all of our charts. The blue is the 20-period moving average. The red is the 200-period moving average. We use these two in a buddy system. And the first thing that we do before the market opens is, for instance, if Google is on your list, and it should be on your watch list, your daily watch list. If you play US equities, you should have Google on your watch list. The first thing we want to do before the market opens is to grab the state of the stock. And we do that. One quick and dirty way of determining the state is to judge the space between both of your moving averages. Now we see that 20-period moving average and the 200 are relatively close together. That tells you that you're dealing with a narrow state. That's a narrow state. That's a quick and dirty way of doing it. Both moving averages close, narrow state. You can have narrow state in a variety of ways. You can have it like this. That's a narrow state. Or you can have it like this. Now the flat is preferred. When you have a narrow state and both the moving averages are also flat, that's a higher grade narrow state than the trending narrow state. So the flat narrow state where both of your moving averages are relatively flat and close together, that's an extra special narrow state. This doesn't matter as much, but I do want to let you know how to rank it. When you're looking to go short, when the 200 is the moving average above, that's a little bit better. A little bit. All right? It's not a lot better. It's still takeable if the 200 is the bottom one. And in this case, the 200 is the bottom one. But I do want you to understand that the bigger moving average being the backup is slightly better, very slightly better. The bigger moving average being the backup. So the ultimate backup would be the last stand up here. So that would be the last stand, okay? But we don't have that one, but that's fine. They still work. It still works beautifully. I just want you to understand how to rank them. So in your narrow states, you've got this order. You've got the narrow state, and then you've got the second version, the narrow state, flat narrow state, not just a narrow state. Okay, so the moving averages are flat. And then you have the flat narrow state. I call this the picture of power. So it's like you've got the pop version of it, right? Picture of power. You got the flat narrow state with a pop. The flat narrow state with a pop with the picture of power, meaning the 200 is the top one in a short. It's the bottom one with a long. All right, we don't have the pop today in this. This is good to just be able to judge your narrow states. I got a narrow state. Is it flat? Boom. is it a flat narrow state with pop, picture of power, or not? Don't not take it if it's not pop. You understand? Please, they still work. All right, that's very important. So now that we know what we have, this narrow state, no pop, but still nice narrow state, we know that the best location for this stock to open is anywhere here, anywhere right under. Now, I want you to notice that there's a tall tail here. I was with my black team at the open today, my black trading team, every morning. But anyway, this morning I pointed out right off the bat, there's a bad tick here. Google opened and then there was one trade here, and then it just continued to trade here. Now, when you get a giant jump and you go right back, that's not real. The chart didn't catch, the algorithm of the data provider didn't catch that bad tick. There's bad ticks all the time, out of sync trades all the time, but a lot of these data providers, they have a built-in algorithm that weeds out the bad ticks. Otherwise, the charts would look terrible. Now, they can't weed out everything. Every now and then, a bad tick slips through the cracks, and our charts are messed up because they reflect a trade that should not be there. This should not be there. This tail doesn't really exist. Tell me you understand this. It's an out of sync trade, which I'll explain in just a second here. But tell me you understand this, right? That tick that formed was one single trade that was out of sync with the bulk of all the other trades. You got this? You understand? Makes sense? I know we're on a delay. I just want to see. Make sense? Good. Okay? So understand, guys, that if your stock is trading at 168 and you see one trade at 169, and then it goes right back to trading at 168, that's an out of sync trade. It's impossible for that to happen. Do you understand? It can't happen. Here's how some out of sync trades occur. By law, trades are supposed to hit the tape by law. So by law, if a trade took place, it is ultimately supposed, the terminology is called, it's supposed to hit the tape. The tick, it goes back to the days when there's just ticker tapes, all right, or ticker tapes coming out of the bubble, and then the ticker tape running across the wall in more modern years. Okay, that tape or that ticker coming out of the bubble, that's considered public information. So every transaction is supposed to be revealed to the public on the tape. And so if a transaction wasn't, if it was missed, oh shoot, we forgot, somehow this transaction didn't hit the tape, but it happened yesterday. We got to print it. We got to make it hit the tape. So if a trade from yesterday, right, got missed, sometimes right at the open, they'll just print it where it took place yesterday. Now, if you go back and look at this chart, right, check this out. You'll see Google opens here. There's a bad tick right here. You can tell this is from yesterday. A trade there somehow got missed. They printed it, and then it resumes back trading where it should be trading. So that's how some bad ticks or out of sync trades happen. Now, your data providers try to weed those out, but like all technology, guys, it's not absolutely perfect. Every now and then, one of these out of sync trades just slips through the algorithm and just messes up our charts. A lot of times, these missed or out of sync trades, they tend to occur with a lot of programmatic trading. A lot of the programs that program trading hits the market and certain trades are missed, and they have to when they realize they ultimately have to print it. I want you to look at this as if the tail is not there. Let's take it away. I want you to kind of look at it more like that. So Google opens, boom. Now, first, this happens in seconds, guys. A little move up here, and we move back down. I'm ignoring that bad tick. And then this starts to produce some red here, and then some more red. So, guys, to be honest with you, I take an early swipe at this. Boom. Okay. Now, I don't want to get stopped out up here, so I'm not going to get stopped out near the help. The 200 is my greatest help. So I'm just not going to get stopped out there. All right. As you can see, even the stock coming back, the 200 helps you out here. So I'm just not going to get stopped out there. My stop has to be over the 200. So I'm going to use a maximum loss per trade. All of you need a maximum loss per trade. Now, if that's $80, then you got to work with that. You know, can you get your stop? Is 80 cents get your stop in the right way from your entry point with one lot? If it's $100, does placing your stop close to $1 away from your entry is that stop in a good place? All right, so I want to be over that MLT, over that maximum. I want to be over that 200. So if I enter here and 2 lots makes my stop here, then I realize 1 lot has to be the play to get my stop there. So my maximum loss per trade also helps me determine the potential size of the play that I can take. All right, so anyway, in stop maximum somewhere up there, okay? Now, this drops hard really fast, okay? I take profits on the first drop here. Now, here's where my other traders come in. They really complete the trade better than I do, to be honest with you. All right? So we're in, let's say 2, stop, out, 1. I want to show you, I talked about this on a variety of occasions, but I want you to see the hidden move up. It's not so hidden when you're watching it live, but it's hidden now, right? The hidden move up is here. We move up off this low. We continue to move up. So if in between this bar is actually green, giving you your real first color change, but it's hidden. Boom. So if you took profits here, some of my traders are actually in on the bounce. All right, that's a little advanced. Or you can be in on the color change, and your secondary micro profit taking is here. Now, if you look carefully, this is a miniature whale. We are always going after this event. Boom, boom, boom. It's a very simple one: initial bounce, initial drop, bounce, drop. All right, and if you look, you got it. Drop, bounce, drop, out. Drop, bounce, drop, out. Drop, bounce, drop, out. And the way this is played is enter, exit, enter, exit, and if you have another one, exit. Does this make sense? This 3-legged move, drop, bounce, drop, in all of the places that you act in this 3-part move. Do you understand this? Do you understand the 3 parts? And do you understand where you act in the 3 parts? Good. Enter, out, enter, out, out. That's the quintessential template that you are trying to repeat on every move. Whether it's micro or macro, is this ad too far away from the narrow state? No, not even close to being too far away. It's not, guys, it's not. So Tony was asking, is the ad too far away down here? And the answer is no, because you're not supposed to judge the ad from the narrow state. You're supposed to judge the distance of the ad from your entry, your initial entry. So assuming that your entry is correct, this is not too far away. And even down here is a good entry. So here's your entry zone. Here's your ad zone. That's your entry zone. Here's your ad zone. That's not too far away. Now, if you're adding down here, if you're entering here and adding down here, that's too far. So remember, what you're after is enter and add. You see how they're relatively close? Or on a micro, enter, add. Now, if I go and mark this up, everything is that template, guys. Everything we do is that template right there. Everything we do. You think about it. Whether we're doing long-term or very micro. All right. Let me show you long-term. All right. Let me show you long-term that it's the same thing. So if we go to boom, 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 it's the same thing. Then repeat. You see? It's the same thing. Boom, 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 boom. That's all you're doing. We're always playing that. Do you understand? Boom. You said in Bitcoin we don't sell, but if you were selling, you'd be doing that. Does this make sense? It's the same thing, whether you're microing or whether you're macroing. And maybe you have an ad here. Does this make sense? What kind? Do you have a narrow state? Yes. Is it a flat narrow state? I'd say yes. Do you have pop? Yes. You've got pop. Picture of power. 200 is under everything. Is the bottom item, right? So now you get red, red. As soon as if you get red first, then it's just a color change play. Boom. Ania's asking, can you confirm on the 1 minute chart? Sometimes, but the key thing, Ania and everyone else, is that if you are watching your stock because you have pulled your stock out of a list to be watched right at the open, let's say, and this happens, I want you to be able to know when it's real or not. We're going back. We weren't living it live. We can go back to the 1 minute sometimes to detect. I'm more concerned with you about to take a play or watching a potential play and this bad tick happens and you don't know whether that's real or not, because that can throw your whole trade off. It can prevent you from taking a good trade or throw your trade off. And I want you to be able to determine when you're watching it happen if it's real or not. Because if it's just one and it goes right back and that one transaction is way away from the price, that's not real. You can ignore that. It might show up on your chart, but try to ignore that. No, not dark pool prints. I explained in most cases how it's formed. I want you to really practice judging your states. Do you have tight and narrow? Are those moving averages close? Are they flat? Do you have pop? Get in the habit of practicing that. What's the state? And not just at the open. You can have a narrow state later in the trading day, which in a way is like a brand new open. You might have a stock that gives you 3 opens in the same day because a narrow state flat, and you don't need pop, but especially if you have pop, that's like the stock starting all over again. You understand? It's like a brand new open in the middle of the day. This is not just a concept for the open. This can happen throughout the day. And it's not just a concept for equities. This is the same thing you look for in Forex, in every market. You look for narrow state. You don't need an open.